Joel Dixon, let's talk about some ETF ideas for 2016. And the first one is the use of limit orders, because this is something which caused people a lot of trouble back in August of this year.
Yeah, so it's not so much an ETF issue as opposed to how to trade the ETF. And best practices when you think about trading ETFs is to use limit orders to give yourself some price protection. A lot of people tend to use market orders or even stop loss orders. And the problem with that is when you get into a big market volatility environment like we had on August 24th, the market order says execute at any price immediately. And you don't want to execute an ETF at any price. You want to execute it at the price that's representative of its underlying securities. So use those limit orders to help protect yourself when trading.
Another big buzz term in 2015 was smart beta. So how smart was smart beta in 2015, and will it continue to be smart in 2016?
Look, smart beta is the ETF version of active management. It's basically taking active strategies, putting it into an index form, and now all of a sudden saying that it's better. But it's just the historical active-passive debate. You're certainly going to see more smart beta or more active strategies in the form of index products. The smart, though, of smart beta, to me, it's an acronym for a silly moniker for active rules-based trading. And know what it is, do the due diligence. Is it a strategy you want in your portfolio?
Well, some due diligence when it comes to ETFs is backtesting. We had a whole lot of new ETFs in 2015. Can you talk about how investors can look into the back tests of ETFs? Because sometimes they don't even provide it.
Yeah, when new ETFs are created, they're often tracking new indexes. In fact, I did some research a couple of years ago that showed that 60% of ETFs coming to market were tracking an index that was less than 6 months old. So how do you do that? Well, you take a strategy, you say, how would it have performed historically, and then offer that with the hope that the back-tested approach would continue in the future. Providers, ETF providers, generally can't show back-tested data, but the index providers, the ones that have developed those indexes for the ETFs, often can. And the rub, if you will, is that you tend to only see indexes or strategies that have performed well historically coming to market in the form of new ETFs. In other words, it's kind of like rearview mirror investing.
All right, let's talk about performance. Vanguard, which is almost synonymous with index investing, is actually working on some active ETFs. Can you talk about your progress and your plans for those?
Well, I mean, Vanguard has always been about low-cost investing, whether it be in index or active form. And we do have an application on file with the SEC to launch, or at least to get exemptive relief for active ETFs in the US. And we just actually today, December 10th, launched some active ETFs in Europe. So it's part of our overall approach to the ETF market.
All right, and then finally, there was a fight this year between Larry Fink and Carl Icahn over the safety of high-yield bond ETFs. Where do you come out on that? Are fixed income ETFs safe, and specifically high yield?
Again, so fixed income ETFs actually have shown a lot of ability to provide price discovery when the underlying securities in the fixed income space tend to not trade as well as, say, equities do. And that price discovery mechanism through the ETF form has actually been very beneficial for fixed income investors in knowing where those types of securities may be priced. But again, back to sort of the first question of, when you're trading these, though, you need to be careful about using limit orders and knowing in what sort of band, if you will, the ETF should be valued.
All right, well, thanks a lot, Joel Dixon.
Thank you.
And thank you for watching The Street.